Just want to be sure that everybody understands TuneMap, because I'm not sure that everybody has ever coded in TradingView. But the point is, in TradingView, for example, if you want to code a 2 EMA strategy, you have your code, and here I'm testing on the stock Snowflake, for example, a 9 and 14 strategy, and then I compile it, and then it run, and then give you the stats. So in the case of snowflakes, would be a pretty bad strategy, as the buy and hold. Well, I mean, buy and hold would be losing on the 10,000, so it will lose 19%. But using a 9 and a 14 2 EMA strategy, I will lose almost 60% of my capital. So that's not a good strategy. So then if I want to explore, I need to change them. And then I could try, instead of a 12, for example, and a 14, and then run the strategy again. And then look at the result here, which actually I went from almost minus 60 to like something more around minus 50. So that's probably better. And I could play with that and go up to a 22, and eventually I will go to 22 and 29, and I would find it's pretty good strategy here. So while I was losing 60% of my capital using a 2 EMA crossing strategy, setting on when they cross bullish and when they cross bearish, I would find that with snowflakes, using a 22 and a 28 is incredibly good strategy. And so, but the point is, finding them is, you need to try them, and it can take. So the idea of TuneMap was to make it pretty straightforward to see. So it's something we were doing internally before, for validating every threshold. So if I go see snowflakes here, we pre-compute it, and you will see that 22 and a 29 strategy is near the optimal. So basically, let's start by that. Here's the return, is the amount of time you outperform the buy and hold. So more red, strong red it is, better is that position, more optimal is that configuration, and more going to black or very dark blue, it's a very bad configuration. So if you look at the first configuration that I tried, was about this one, and like I said, it was around minus 60. It's not this exactly same period, so number is not exactly the same, not right now. And we were underperforming the buy and hold, while when I go back to my 22 29, it's a pretty good strategy. So it's way to visually see exactly where we are. Usually what I will choose is optimal point, but optimal where it's kind of in the middle. So it's something that I showed years ago in presentation about intrinsic entropy. I show a bit our reasoning, that if you find, because sometimes you could have just a small point around here or here, it's usually you want to be in the middle of an optimum. And the reason is that if stock behave a bit differently than in the history, it should lead to similar results. So yeah, and then you can see for each point what are some of the stat, and partially the hit rate, but also the amount of trade. The amount of trade is something. For example, I'm really not a. I know that some of you might have times and or might love to trade very often. I'm not very good at trading each day, so I'm not usually go into a configuration where I will trade a lot, many times per week. So I usually more like a holder. So I would be perfectly okay with that given strategy. Uh, Then you have this other thing, this simulation filter. And just to explain it, and I think it's one of the important thing to understand. I did a couple of slides. It's let me just okay. So just go into full screen. When you invest, there's only one certainty, is that the trajectory of the past will never repeat exactly. So it's not because you tested a strategy on this path thinking that it's going to work as well in the future is utopic, because it's never going to rehappen. And when you test a strategy in TradingView, there's not much thing you can do to test it in the future. So one of the solutions that most people use, and that we also use at Wealth Umbrella, is the hold out period. So usually you will test on a stock a certain amount of time, and then you will test it in last 1-2 years of the stock history. One of the reasons usually we have a holdout period is overfitting. Okay, here just it's an academic example for AI, but I think it's relatively easy to put in context here. Let's say you have green dot and you have blue dot. Let's say green dot is you should hedge, market's not going well, and blue dot is you should be in the market. It's what you want to do with a strategy is to trace that frontier where you're able to separate those two. The left side, it would be probably the best frontier you could draw. If you have a complex strategy that can overfit, and any complex strategy will do that, it will start to trace a very strange boundary that actually encompass all those dots in the right order. But although the result of on the historical period will be awesome, uh, that line doesn't make sense. And when you will get new dot along that line, it will probably very often misclassify those points. So that is what we call overfitting. I made this quick example. You don't really need to understand AI for that. I use the TensorFlow sandbox for that. The TensorFlow is the AI API for from Google. But anyway, this is just here. I put it like the most complex in that sandbox data that I could do. It's separated data here that is still, again, like just think of the orange one as we need to edge, and the blue one we need to be in the market. So there's some overlap. And although the frontier would be easy to draw with a pen, that it should be, since we have a complex network, it can overfit. So it can start to create very strange orange zone to try to grab those dots in the middle. And that is overfitting, because probably if you have a blue dot in the top orange zone here, you should still call that a blue, but it will call it orange. And that's not what you want to do. And that's its overfitting. And that's the reason why you usually want to test to be sure you don't overfit into a period you didn't touch. But the thing is, when you have very simple networks, so the edge strategy is complex. So it's very important. There's 4 years, it's 5 years now, that has been untouched for the edge strategy. It's just real time. We never use it for back testing, because that's very important, because there's a lot of criteria, parameter, and that could easily overfit. But the thing is, when you have a very, very simple strategy, like in this example is one neuron is tracing a line in the space, and like it cannot overfit. It's just a line. And the thing is, when it comes to TuneMap and we talk about technical indicator like a 2 EMA strategy, a MACD, RSI, it's very simple things. It's just line that are filtering of the price and they cross. It's pretty hard to overfit. So it's not about overfitting. So the fact that we don't necessarily have a holdout period, it's not a problem with overfitting. The issue is not overfitting, is exceptional historical event that can distort the optimal result. And I will give you this example. If you remember last summer, in July, CrowdStrike caused a major global outage. So, and stock went minus 50% in a few days. About minus, I think it was minus 49. Those things was completely outstanding behavior for CrowdStrike. It's something that is highly unlikely that it ever happen again. And the thing is, it will completely shape the optimal map. So if you look here, is the result in TuneMap for CrowdStrike. If you look here, you see all that point of optimum. If you click on them, you will see that they are all strategy that sold very, very early and that jumped back in a ship relatively at a lower price. There's some that went even better than that. So any strategy that would have worked well, even though they don't work as much well in the regular behavior of CrowdStrike, will create outstanding return. So they will highlight it. And that is one of the things you really need to be careful. And particularly in a stock that has particular event that were outstanding in their past, incredible jump on earning or stuff like that. So it's a fact you will not see as much on Apple, Microsoft, or more regular steady uptrend stock, but stock that has major drama, you will see them, and it's pretty hard to trust the return map. So it's really this thing you want to shield when you use, because a 2MA can barely overfit. And a holdout period would not be that great for that, because a holdout period of a 1-2 year, because you need some year to backtest. You don't want to go 10 years, because the behavior of a stock 10 years ago is probably not a good reflect of what it is today. So you don't want to go. So let's say you go 5 years for training your strategy, testing your strategy, and then you have a holdout of 1-2 years. Would not really help you much, because you will only have, maybe depending on the strategy, how often you trade, you could end up having only 1 to 5 trades in that validation set, and which will have very limited statistical validity. So what we did, and what is usually done in the institutional world, is using Monte Carlo simulation. Is basically we simulate, we model the behavior of the stock, and we simulate 10,000, 1,000 in our case, different other trajectory. And what we use in our case, just for a person or more tech, is JGR Garch. I'm not going to say the name here. And what JGR Garch do is it's model the stock volatility behavior. So that's the Garch, is the fact that volatility come in cluster. So as you know, VIX rarely only spike for a day. It's usually spike, and then so it really come into cluster. So that's the Garch part, that the generalized autoregressive conditional heteroscedasticity part of the model. And the GGR is the volatility is asymmetric. So volatility is not the same on the way down. So it's usually that it is on the way up. So here's the COVID drop, and you see how quick it was compared to the uptrend. So volatility is asymmetric, it's not the same. So that is the model we use. And the result of this is really, it's really real trajectory we get. It's similar trajectory. Here is one that I took for Apple. I took it randomly out of 10,000. So there are 5 years of daily data we generate, and to them, sometimes we'll have like this one. There's a 25% fast crash. They have like a year-long bear market, and they will model the behavior of the stock very well. If you look, here is a Fubo, which was very high volatile stock. So you see in red, in blue is the historical realized volatility, and you see one trajectory here that I calculated the realized volatility. So they match pretty well, those realized volatility. Unlike like Apple is lower volatility, and then the simulation will be lower volatility, and the way that volatility move is also pretty similar. So it's pretty identical. It's trajectory of the stock it could have, and so they each represent 5 years of price action. They are each unique. So here you see for that simulation for Fubo had a more euphoric uptrend, and then that's the realized volatility, but that was like relatively high volatility here, and lower volatility here. So different trajectories. So we use those 100,000 simulation. So yeah, if I go to CrowdStrike now, so what we do is we use the Garch, and it generates a different map. And the fact that it's thousands of trajectory, it's more continuous map. And as you see here, we created a filter that overlap the return, and it will deactivate the zone, like that zone that was the optimal before. It deactivated, and then show you what should be probably the most optimal zone you should have considered. And that's probably if CrowdStrike would have never had this bug issue last July, that's probably the map you would have seen, something more close to that. So in that case, you probably want to be more into those point of strategy here. So that is for CrowdStrike. There's other strategy tool, different strategy. For example, phase angle. Phase angle is an indicator we did almost 4 years ago now, more than 4 years ago now. It's really captured the momentum. It's something that will tend to work very well at the market level. And the reason is that on a stock, momentum kind of changed. Sometimes stock in part of history is kind of unknown, so there's not big momentum. Then it became known, so a bigger momentum. But if you look, for example, at TQQQ with a phase angle, and you would choose like the optimal threshold around here, it would match TQQQ return, but will provide you some good edge. Would sell here and then buy here. Would have sell in last summer correction and buy here, and would give you some good threshold for good, and still shielding you from some drawdown. So that is Q. There's other one. There's the MACD that I will cover because it's a bit. It's a bit different than the other one. So let's go to Snapchat. So on Snapchat, on the MACD, you see that the simulation, the gauge simulation return is something pretty similar to the return, as the map kind of highlight this similar point. We'll deactivate a bit that area, but we'll strain in this one. But let's pick an optimum here, like that. The MACD Plus fix some of the MACD issue, less lag. We use different thing, something we call double EMA or zero lag EMA, which are not necessarily zero lag. And we also scale the amplitude. So if you look, unlike conventional MACD, they will tend to oscillate in the same range no matter how the price was different back then. So it can also give you the information of where you stand, or how much oversold you are. But and the last point is hysteresis. Is one of the main issue with MACD, and same thing with 2EMA. So we'll probably release somewhere down the road the 2EMA strategy with hysteresis. Almost anytime we use 2EMA, we put this hysteresis zone. So one of the main issue of having two lines that can cross is when the market goes sideways, they kind of cross very often, but you don't necessarily want to shield from that. They cross because market goes sideways, they are close to, but it's not because they go into drama. So once you choose a point of optimum here, you can compute these hysteresis. And the reason we ask compute is here, just making those map require a lot of computing time, and we do it for almost 5,000 stocks. So it take days to make all those map. And for each of the point, there's also another map of hysteresis. So alpha and beta is the width of the hysteresis zone. So so anytime we will have to compute those 4 factor, and this would be hard to display. So it's the reason you do this in 2 separated steps. So you choose one point and then compute the hysteresis, and then you see if you can improve. And you will see the hysteresis zone often boost the return, not by much. It happened, but it's rarely like 2-3 multipliers. Usually something around what we have here is multiplied return by 1.15 or something. But the thing that I love, it's usually lower the amount of trade. This is maybe not the best example, as we're 12 trade and go -2, but sometimes you have strategies which are something like 40 trade inside of the last 5 years, and then you bring it down to something like 20, which is completely changed. Partially for me, that I don't like to trade that much, and I think less you trade with the same return is probably more confidence you have into the strategy. There's one thing though, this might be the optimal point, or close to very the optimal point here. It doesn't mean that when you compute this hysteresis that the optimum combination of it is not, it's exactly the optimum of all the system. So what I mean here is maybe you have a point here that the hysteresis return would boost it. I think, yeah, I found that example that the hysteresis return No, because it was a lot more bad. But the point is, it's something we do in algorithm. Usually, when there's too many parameter to scan or to display, is for example genetic algorithm. It's what we do. We take good configuration and then we start from that good configuration to explore other parameter. It's a whole field in itself, and it's one way until we have quantum computing easily available, which will be good at scanning a huge amount of parameter. It's something we do. So, but still, it's usually will give you just like a better point. So like that for Snap, the buy and hold return was minus 52.7 strategy return, so it greatly outperformed. With these thesis, it did improve a bit, and it lower a bit the amount of trade. If you want probably lower trade as soon as you're here, you go a bit into lower trade. But again, it's not the best example. Sometimes you can cut the amount of trade by two. So yeah. So yeah, that's pretty much cover what I had to say about TuneMap. It's something that personally, it's something we're doing on almost every indicator. We made it for Wilt Umbrella. So we decided to make it as if we're going to individual stock, it can help you build strategy that fit your investor profile and also that could help you protect your capital. So I really hope you like it for as much as I like it. Well, that's pretty much the end of it. I will take more questions. So maybe there's two map
Vincent?
specific question. Yep.
Yes, yes. There's two questions about the statistics. So if you may, I might just go across all of the statistics
Yeah, sure.
through my
I'm
screen.
Yeah, I let you present your screen.
Perfect. Uh, give me a
Yeah,
second.
we see your screen.
Perfect. Okay, so first, all the statistics are computed from the long positions only. So a trade is defined as a buy and a sell signal. We did not compute the sell to buy signal in this section since we think that shorting is well, it could be a good strategy, but not for everyone. And long only is maybe the normal case. Um, so first, the normalized returns is the same as this map. It's basically by how much the return of the strategy outperforms the buy and hold return. The hit rate is simply the number of trades that ended up with a positive return over the total number of trades, which is the total number of trades is below here, so 7. The buy and hold returns is well, it is what it is. I mean, the return during the final period, and it can change. I've received a few emails asking about this, and I don't think it's the place to go over exactly all of why we did that way. That I will point you to our blog post that explains all of it. But the entry and exit uh, of the buy and hold can vary slightly depending on the strategy we've chosen. And this was to prevent some tail end skew that could occur when, let's say, the strategy ended on January 1st after a big upturn, even though the actual exit would have come at a much lower point a few weeks later. That would like save a good trade in the strategy return, which would amplify the return and make it seem like it's better than it is. So that was the gist of it. I strongly suggest that you go into the blog post to really read why we did it that way. Then average win loss, it's pretty
Actually,
self-explanatory. Yes,
Zach, sorry. If you allow me, I responded to a question on that last week, and it's very deep into the comment section. I will just repost that response on top of the comment in the TuneMap post. But I gave more precision, and I think that was in the blog post, and I think it's an important topic, like why it changed and why we had to do it this way. And believe me, it's the optimal way. But there's it could bring some issue, but yeah, so you could go after the webinar in the comment section. I will post it on top of the comment.
fantastic, good idea. Uh, Then yeah, average win and average loss is pretty self-explanatory, and the ratio of both is also. Now, buy and hold period and strategy period. Well, strategy is the time in the market for all the trades combined, and the buy and hold period is, as we've said, varying across different strategies just to have a better comparison. Buy and hold drawdown is the ultimate drawdown seen during the buy and hold period, so it's maybe not the best one to show it quickly. I'll go with Snap. So for Snap, the buy and hold period, we take the highest point achieved. So let's say it would go up, then we would take this, and the drawdown here would be the maximum drawdown up until that point. And then it keeps going up until the peak, let's say it's here. And then we would compute the drawdown up to the lowest close, which I think would be this one or maybe that one. And that would define the buy and hold drawdown. Some of you may have noticed, I think there was a question about the max single trade drawdown. We changed the name due to a comment we received, and the stat that is displayed here is the maximum drawdown within a single trade. And I mislabeled the name so that it could be confusing. It's not that the statistic is not good, it's just that the name made it seem like it was something else. So what we compute here is that within a single trade, so if we take the buy and sell, let's say this one, we take the drawdown within the sell on its own. So if, let's say, at this point, it's the highest point achieved up until the entry, we would have the drawdown here, and then it would keep going up. So from this top up to the sell, which would be down there, I think that would be the max drawdown, and that would be, if it's the biggest drawdown within each trade on its own, it would be the value here. We will be adding the strategy as a whole drawdown also here in a few weeks' time. This true max drawdown, strategy max drawdown, would be directly comparable with the buy and hold. This one is more to see the worst case in a single trade. So if I enter position, the worst position you could have entered would have seen minus 36% during the position. However, it does not mean that it was a minus 36% loss. It might have recovered after. So, I don't have an example here, but sometimes there's a big dip that did not trigger the strategy, but then closed a bit higher. So it's good to use this strategy to have the trade in context when you're in a position and you know that maybe if you've reached minus 36, you're probably like the furthest down you could go. Even we can always be surprised. And if you're a lot higher than this, let's say you're minus 10%, it can give you context as to how bad it can become. And finally, the average wins over the median win is exactly the same reason as to why we displayed it on the retail momentum screener. Sometimes a huge win can make the strategy very good, but make it seem like it's better. So if we were just to take the average win of 33%, we might think 34 almost. We might think, oh, every trade might be 34%, but mainly there's one big trade. Here, that's a pretty good example. There's this huge trade. I guess it's that one that does like I don't know how much, maybe 3 times or 4 times. And then all the other wins are much more contained. So this ratio being high shows or highlights the fact that one or few trades amplified the average win, and it's to be taken into consideration when going in the trade. So that does it all. I guess there's the MACD. When you compute the MACD, there's also the value here that are updated. Return multiplier is simply the normalized returns, the new return computed as a multiplier of the normalized return. So you can see it here. Actually, we went from 106% to 96, and that's the multiplier between both values. Trade variation is the number of trades that are removed or added by using the asterisk. It should never really happen to add. and finally the hit rate updated from the modification. One comment I've seen and I have also received via email is that we should look into updating all of the stats. And the initial idea was to be able to compare the before and after. But now I do see the point, and I think we will be implementing this again in a few weeks' time, because when changing the strategy with the hysteresis, all those values will also change. And it will be important to also keep them updated. We tried at first to only show the most important ones, but now that more people have played with it, I think it's the right choice to simply update it all. And then the 0, 0 point down here is the no hysteresis point, because the alpha and beta is 0. So that could be the comparison point and would be a better way to do it. Now, I think that would do it all. I don't know if there was more. Yes, Beta Bull, the blue highlights the backtest period that we chose. It is the backtest period, the aimed at backtest period, but it doesn't take into account the days that were trimmed by the thing we mentioned earlier, depending on the strategy. It is like the start and end date that we were aiming for the backtest period. And let's say for most strategies, it is the backtest period. Kevin, I already mentioned this. Okay, well, I think that does it all.
Yeah, it's great. Anyway,
Oh,
it's something we want. Oh, yeah. What is there any other
there was
question?
one last question by Natalia that I've seen. Is there a strategy among the 5 that is more universal, something that you will strat with, or just try them all till you see a reasonable area of red squares? I think, Vincent, you'll be best
Yeah,
to answer this one.
yeah. There's a lot of philosophy into that. There's not a straight answer to that. I would say that most, if we take aside the phase angle, I would say that most of them will lead to similar result. Um, and I think it's normal. They are all price derivative, so it's with some lag into it. So sometimes MACD tend to outperform a bit, and I think it's mostly due to the fact that it use EMA inside with less lag. It's something that I want to do. Like I said, in the future, I want to do a 2 EMA with zero lag EMA and hysteresis zone. So I expect that this one could outperform. Uh, so yeah, phase angle is a bit different. The way it is, it's kind of it was to compensate some flaw of double EMA. It kind of strip the non-important part of 2 EMA. So one of the main issues is the distance that are accumulated between the two line can create artificial lag, or actually can make it trigger too often if there's no distance. And that information is not relevant. The thing that is relevant is how fast they curve, and that's what the phase angle measure, and how fast they're gonna cross, and how quick. So phase angle kind of are just really a mathematically better version. It was conceived to that. So it's sometimes a measure that you can outperform, but there's one issue with it is in some individual stock, uh, you can rarely like the momentum, because that's kind of a measure of a momentum. The momentum changed too much across the 5 year period. So you end up with a threshold that is just kind of a in between. So sometimes it bring back the phase angle to a more similar level to the other one. So one of the thing that we use in the edge strategy, and I think in a future update we'll do, is phase angle, looking at a statistic point. So phase angle inside of like the last year of behavior of the stock and how far it is. So in a regular bull market, this is how the phase angle is used in the edge strategy. And I think in this mode, phase angle would considerably outperform the other indicator very consistently. But until then, I feel like MACD Plus might have more chance to outperform, and the other one should be relatively in line. I don't see a lot why a MACD normal would do much better than a two crossing EMA, and so sometimes the easier is in that case can be the best.
Yeah, that was a long answer, but I think it basically means, yeah, look at each of them and try to find what's the optimal point for you. Uh, the In the end, I think it's easy to just look at the reddest number in returns, but that's not always aligned with what how you want to trade. Vincent mentioning earlier that he prefers a lower number of trades and being a bit more quote unquote passive. So you have to take into account your own risk tolerance, your trade style in quote, and what you want to achieve with this investment. So
Yeah, and I would add
unfortunately, there's no
also,
simple answer.
that uh, I know it's always tempting to take the optimal and the historical return, and but don't ignore the simulation filter. There's a reason we do that. There's a reason institutions do that, and there's a reason we think it's a feature that lag considerably into trading view. It's because it's not a time machine, so you don't exactly know for sure with that, but at least it can help you strip what might be an aberration of the past. So be careful of that, and sometimes it's probably better to take a point that is the optimal in simulation filter, even though if the stat will not be as impressive in what you will see on historical.
Yeah. There's three more points. I will go really quickly because it's almost 2 hours now, and nobody will rewatch 2 hours time. So first, wouldn't it be better, more correct, to show the statistics for the filtered returns instead of the original ones? I'm not sure to exactly understand, but I'll try to answer. The simulation filtered isn't the expected, like the value from 0 to 0.35 right now is not the expected return. It's more, this map is more like a way to filter out the areas from the returns map that should not perform well on the average 1000 trajectories. So the simulation filtered return map is not showing the returns as filtered, but rather how much confidence we have in a point that it should expect as it had in the history. So the range of the values can change, and the higher the better. You should never see like a big one because that would mean the absolute best filtered simulation point would be aligned with the absolute best historical return value. So it should always range. I think zero point 0.5 is the max I've seen. There's sometimes probably a little more than that. So that's why we do not. It's not a return, so that's why we don't show the statistic on that one. Next, Betable, could you give us the optimal strategies for like 2025 stocks, the most popular one? Uh, Again, it goes with what we talked about for Natalia. Choosing a strategy is more complex than just selecting the best point. One feature that was requested is a way to quickly select the highest return, the highest hit rate, the lowest average loss point, like with the shortcuts. And I think that could answer a part of what you're asking. But it is not necessarily it could be a better way to navigate the interface, but I don't think that highlighting like the 20 best returns is necessarily good. More so that among us return are less expected to reoccur, so maybe they're not that interesting.
Yeah,
So
but yeah, and by the way, we thought about that when we designed it because it would be easy to just select the maximum point and then highlight it. We wanted to do it, and then we realized that sometimes it's not the case for Snap here, but what we see on the screen. But some of the stock, it come with very high level of trading. So we thought that would be misleading people to just highlight automatically the optimal point. But still, compared to testing everything in Trading View, it's still good to see the region which is are very optimal and then being able to see the stat associated, and it's the reason we put it all those graph here is to see if it fit uh, your loss profile, if you're okay with max drawdown that it generates. So
One last question, maybe for you, Vincent. Are strategies with very low amount of trades also robust? There are great strategies with long-term EMAs very close to each other, but they have only a few trades. Do you trust them
no,
as well as the other ones?
there's it's yes and no. So the first is, yeah, I think partially if the gauge filter, it's usually those case the gauge filter will agree with them. And I will tell you why. So, like, if you go with Apple and you will see, or Microsoft, you will see that a gauge filter is pretty similar to the return, and it's usually going into the very top period. And what's this telling you is that Apple and Microsoft, the best thing you can do is just to hold them. So the fact is, the simulation, the fact that is actually 5,000 of year. If you think about 5 years time, uh, thousand of strategy of trajectory. So the amount of instance if they coincide is relatively good. Uh, the point here is, you're right. It doesn't generate like the example, the point that Zach just choose for Microsoft generate four trades. So basically, what that strategy tell you is you're just better to own Microsoft. So the point is, you need to be careful with this. Is there's always one thing that no model can take, not trading view or anything into consideration, is the stock will change in the future. And so that's one of the reason in the future, and that's probably be more long time than the small thing that I told you. But I want to have a stress test behavior. The thing is, those strategy for Microsoft that look at the optimal. If Microsoft completely changed, just think of what Microsoft had a rough 10 year after the dot-com bubble. I would even say 15 years, but so maybe that strategy wouldn't be that good. Uh, so anyway, point is that's more indicative when you see that the optimal is here. That is the stock that is more a buy and hold stock than something you need to be chill. So in that case, you might want to just choose something a bit more reactive or a strategy just to take your profit, like the 2 ATR that I mentioned, or yeah.